Right, we are going through international parity relations. And one thing that we learned first is interest rate parity. And the other thing that we're going to learn is purchasing power parity. Now, what's the idea here, right? The idea. Well, the key idea is this, right? The goods, right? The same goods, right? Should have the same price. Law of one price. Make sense? So in product market, gold or silver or whatever good that you have, right? The same good should have the same price everywhere. Okay, that's the key idea behind the purchasing power parity. I'm going to get back to this one later. And interest rate parity, okay? What was the idea? We had no arbitrage condition there. No arbitrage condition. Remember I said, what is the forward rate that precludes arbitrage, right? So it was arbitrage equilibrium. What was the idea? Arbitrage, law of one price. Law of one price applied to securities or risky asset or whatever investment asset, okay? The same payoff. If there is one security, okay, that gives you the same payoff, identical payoff, depending on the boom time or bust time state of nature, okay? In boom time, it will give you $1. In bust time, it will give you nothing. If there is one security like that, okay, that security has to have the same price in whatever market, okay? So that is what we mean by law of one price. And then if the law of one price breaks down, then there may be some arbitrage opportunities so that the astute investors will take advantage of it, like hedge funds, right? So that was interest rate parity idea. Now getting back to this purchasing power parity relations, let's apply this kind of idea to product market instead of security, right? What product? For example, a basket of goods. What basket of goods? For example, Big Mac index is there for you. Okay, Big Mac index. What do you mean? Has anybody been to McDonald's so far? Okay, I guess a lot of you, most of you have been to McDonald's in your life, right? Until now. If you haven't, go there and try some. Okay. The thing is, McDonald's, the Big Mac is their representative product, right? What is that about? 3 pieces of bread, okay, 3 layers of bread, and then 2 layers of ham patty melt or something, right? Or something. And then the vegetables in between, and tomato slice, and then onion a little bit, and then tomato ketchup, right? Or mustard, okay? So this is, you can consider this as a basket of good, bread and vegetables and then meat or something. Or consider this as just single good, okay? It doesn't matter. The idea is Big Mac in America and Big Mac in Korea and Big Mac in Japan or Big Mac in China or Big Mac in Germany or Big Mac in South Africa or whatever, right? They are the same Big Mac anyway. The quality is controlled very good, okay, and very standardized manner. They don't sell Big Mac with kimchi over here in Korea. They don't sell Big Mac with sushi or sushi Mac. No, maybe they could try it. You make a business over there. But when it comes to Big Mac, it's Big Mac is Big Mac. Is Big Mac is Big Mac. Everywhere, all around the world, so they should have the same price, okay? So let's take this idea, and then the only difference, right, should be the currency denomination in different countries. Big Mac in Korea is denominated in Korean won, whereas it is denominated in US dollars in America. And it is denominated in Japanese yen over there, and it is denominated in a euro in Germany, right? So, those ratio of this currency denomination based on this Big Mac, right? It should be the same as the FX rate, foreign exchange rate. Doesn't it make sense, right? The same product, we are just denominating in 2 different currencies. So the ratio of these two currencies should be the foreign exchange rate. That's the key idea. Okay, that's basic intuition. So the example over here, exchange rate between two currencies. Yeah, let me state it here. Read it a little bit. Should equal the ratio of the currency's price levels. So spot exchange rate between US dollar and British pound should be the price level or the price of one consumption goods, basket of goods, right? And priced in US dollar divided by the same goods prices denominated in British pound. That ratio must be our spot exchange rate. That's the basic intuition, which makes sense, right? And for example, if an ounce of gold costs $300 in the US and 150 pounds in the UK, then the price of the pound in terms of dollars should be what? $2. Okay, $2 per pound. That's that. And then, likewise, you can construct a Big Mac index, right? Big Mac index, based on the Big Mac prices all around the world, right? You can look at it, refer to it in The Economist magazine. By the way, The Economist magazine is perhaps the best magazines that I think you should subscribe to, okay? It is worth investing, okay? This is the best economics and finance magazine by far in terms of the level of analysis and then the intuition and the way it is covered and then story told. You have to memorize those things, right? If you memorize those things and it naturally comes out of your mouth, right? Then surely you will get a job without any problem in whatever country it may be, right? And then it's much better sometimes than, very smart, even better than most of the professors' explanations and things like that. The journalist over there, the quality of journalist, super duper, okay? The journalist in Korea sucks, I'm sorry, but that's the reality. No matter what, okay? Compared to economists, I say that, right? The economists, the journalists, they have much more better level of knowledge than the PhDs or whatever professors. I guarantee you. So you gotta subscribe to that magazine and then see what they are talking about, right? And then getting back to this idea of purchasing power parity, right? Big Mac Index. Economist generated that, right? Invented. I suggest to you one thing. One is what? The Starbucks index. Maybe you can think about it. Okay? Maybe I will take it as a homework for you. Okay? Purchasing power parity, or instead of Big Mac index, you can think about Starbucks index. Should it be Americano? Yeah. Americano in Starbucks in Korea versus Tokyo or New York, they should be the same product. They must have the same prices, okay, in general, right? So, think about those things. Anyway, so that's that. Now, yeah. Alright, now we have a light over here. Good. Suppose the spot exchange rate is $1.25 per euro, okay? If the inflation rate in the US is expected to be 3% in the next year and 5% in the Eurozone, okay, then what happens? Well, one currency's value, okay, is going down faster because of the inflation rate, higher inflation rate. That means it should affect the exchange rate, okay? If my currency, for example, in this example here, 5% is what? 5% in the Eurozone, the Euro currency value will go down, okay? So it should affect the dollar to Euro exchange rate, okay? The Euro will devalue, okay, depreciate faster than United States dollar. So how can we model this thing in the forward rate idea. Okay, then the idea over here is that let's just stay away from interest rate parity for now, just for now, but just focus on this inflation rate and purchasing power parity idea. Okay, the same goods have to have the same price, no matter whether it is in the US or in the UK, right? So the equation has to hold, okay, between the US and the UK, but going into the future, we just have to reflect those inflation rate. So US dollars, $1.25 used to be equal to 1 euro. So that equation has to hold at spot market. But in the future, okay, the US dollars inflation will take place, and then the whatever that used to be 1.25 US dollars should be 103% up compared to last year or previous year, right? So the goods that the price level would be 1.25 times 1.03, reflecting the inflation rate in the US, I'm sorry, in the US, right? And on the other side of the equation, the euro, okay, euro regime has to be there. Euro currency, whatever goods, right, the price level was 1 euro before, and then 1 year later, it's gonna be 1.05 because the inflation rate is 5%. So the equation still has to hold even when we multiply those 1 plus inflation rate for the US side and 1 plus inflation rate to the euro side. Okay, so this equation should hold. That's the basic idea. And then that will give us some good idea about what the forward rate has to be. Okay, forward rate has to be. But by the way, the interest rate parity relations that we studied before, that was just you can think of it as one solid model, okay, to attempting to explain those forward rates. And here, purchasing power parity, we're coming up with another model based on this inflation argument, okay? So you can think of it in two ways like that. Now, the euro will trade at 1.9% discount in the forward market. As I said before, right? Euro regime, they will have higher inflation rates compared to the United States, okay? So that's why their currency value will be depreciated. That will be reflected in their forward rate, okay? Forward discount, 1.9%. How do we know that? Well, forward rate to spot rate relation, we can think about it based on the previous formula over here, okay? And then, so that gives us this 1.25 to $1 relation times, what's that? The previous, the spot exchange rate is here, and then forward exchange rate is here, right? And then it tells us that these two common things cancel each other out, and what is left will be this terms over here. That is nothing but 1 plus the inflation rate, expected inflation rate in US dollars, and then 1 plus inflation rate in the UK, right? Did I say UK? No, Europe. Okay, I'm sorry. Similar pronunciation. Sorry. Okay. Brexit guys. Sorry. Didn't mean to bother you. Okay. Relative PPP says that the rate of change in the exchange rate is equal to the differences in the rates of inflation, right? In this case, roughly 2%, right? 3% plus versus 5% difference, right? Now, PPP and IRP, notice that our two big equations equal to each other, right? In PPP, we have purchasing power parity. We have this relation using the inflation rate. Forward rate to spot rate relation, okay? It's explained by 1 plus inflation rates ratio. And the interest rate parity that we learned before tells us that The forward rate to spot rate is explained by, or is equal to, 1 plus interest rate in respective currencies, right? You notice that these two same currencies, right? One is inflation, the other is nominal interest rate. I say nominal interest rate here. That's one important distinction that I have to make, okay? Keep an eye on this one. Keep an eye on this one. This is very interesting formula that we're going to get back later. Essentially, what needs to hold to have these two equation hold true, right? Left hand side and right hand side to be equal to each other. What should happen? What should happen? That gets back to your economics 101. Interest rate nominal, okay, should be equal to what? You remember something called what? The real interest rate and inflation rate, right? You remember this? Fisher equation relation? Yes, we're going to get back to that idea. Okay? We're talking about this guy level being equal. Okay? Nominal interest rates of two different currencies are equal. And then inflation rates of two different currencies are equal. Okay? All these things have to happen. Okay? At the ratio level. They are not the same, but at the ratio level, these things should happen. That tells me that what? This real interest rate has to be identical between the two countries that you're interested in. The real interest rate. Okay? That's what this implies, right? And anyway, the expected rate of change in exchange rate, right? That we are the notation for this expected rate of change in exchange rate, we'll label it as expectation, parenthesis, or square bracket, small e, okay? Because this is a change in exchange rate. Exchange rate has nothing to do with natural log or whatever. Okay, don't get confused. Anyway, so expectation of small e as inflation differential, right? So we would also reformulate our equations as inflation of interest rate differentials. So forward rate to spot rate ratio, okay? Getting back to purchasing power parity, we know they have to be the ratio between 1 plus inflation rates of each currencies, right? And there, okay, subtract 1 from both sides of the equation, minus 1 and minus 1, right? For that part, minus 1 will become like this, right? Forward rate minus spot rate over spot rate should be equal to this ugly term, minus 1, which will be like this, okay? And then what? The same denominator, the numerator has to be canceling each other out, and this guy should remain with minus sign. So that's why in the numerator we have this one, okay? And then the denominator, well, that's this guy, 1 plus euro currency's inflation rate. So, what is this? This is, okay, the expectation of change in foreign exchange rate, okay? That's this guy, right? So this one, okay, the change in foreign exchange rate is, roughly speaking, the inflation rate differential, right? Inflation rate differential. If you taken, right, my intermediate corporate finance class, when we talked about the risk-free rate all around the different countries, right? With the same risk-free rate, right? With the same degree of the risk rating or credit rating for all for these different countries, right? Why do they have different interest rate? And I said, well, mostly it is driven by those inflations, right? The real interest rate, we assume it to be the same, okay? You may have wondered why, okay? why does it why is that interest rate differential is mostly explained by those inflation rate? Well, it comes from this purchasing power parity argument, right?
Right. So, I had too much fun. I had too much fun working with the voice manipulation. So I'm getting back. Okay. 정신 차려야지. Okay. Good. So here, right? Expected rate of change in exchange rate as an interest rate differential. Well, we are representing the same thing using the interest rate only, nominal interest rate, by the way. The same thing, what do you mean? Well, expectation of the small e, the change in exchange rates, right? That should be forward rate minus spot rate divided by the spot rate, okay? And that turns out to be the interest rate in US dollars minus the interest rate in the euro currency. Given the difficulty in measuring the expected inflation, managers often use a quick and dirty shortcut, which is the inflation rates differential should be equal to, or roughly, the interest rate differentials, right? By the way, why did we represent the inflation rate as pi, nothing other than pi? Well, because it's about price, okay? Price level, p, pi. Oh, that's why. Anyway, so that's that. Going down to the next slide. What we show is the real effective exchange rates for selected currencies. So in this chart, what you see is the strength of US dollars with respect to major currencies in the world, right? Placing the US dollar's value as of 2010. 2010 is over here, okay? As 100, where are you? 100. Yeah, here we are, 2010. This is 100, and compared to this, how has the US dollar been performing? Okay, relative to a basket of other currencies. That is the idea of effective exchange rates. Okay, effective exchange rates. Now, and then here's the average strength of the effective exchange rate of the US dollar. The next slide shows you about the same idea of Canadian dollars, right, with respect to other major currencies in the world over the time period from 1980 to 2015. And then the next slide is Chinese yuan, okay? And then with respect to the world currency, major currencies like US dollars as well as euro and Japanese yen, how has Chinese yuan been evaluated over time, okay? And you see that Chinese yuan was relatively overvalued, okay, in 1980, okay? So the product market, I mean, they did not even export much in the export market because they were in the communist regime. I told you before in chapter 1 and 2, right? The history matters, right? They never joined the global competition until 1990 or something, okay? Or late 1980s, right? So before the global competition, they were like, living on their own. But as they joined the global competition, right, in the product market, they've been managing this Chinese yuan in a very, how do you say? They were, trying to manage this value of Chinese yuan very low relative to other currencies, so much so that their product market competence will be very high. Okay, so that's why the Trump administration have been criticizing China as currency manipulator all across 90s and 2000s and 2010s, right? Their currency has been very, very lowly valued compared to US dollars or major currencies. Now, please come to the world of fair competition. Please, Xi Jinping, what are you doing there, man? So that's what China, the U.S. government is arguing. Okay, I didn't say that; they said it. Okay, all right. Japan, right? Their currency value. As you see, right, their currency value relative to U.S. dollars have been very low before 1990s. This is what made the Toyota Motors and Sony gadgets so cheap, right? Compared to General Motors or compared to Zenith or Philips, and then they were beating all the product market competition. Cheaper products, thanks to managed FX, right? But after Plaza Agreement in 1980s, right, they had to accept, right, this appreciation of Japanese yen, okay? And then in early 1990s, right, their Japanese yen was like, their value was skyrocketing high. This is when they felt, the Japanese people felt so rich, so that they purchased what? The Rockefeller Center of New York, and then all the real estate in all around the world. And then they felt very, very extremely rich, right? And then the bubble took place in Japanese market. This is the point over there, okay? And then afterwards, the lost 3 decades, right, is going on, and then the currency's value has been relatively, recovering back to its, normal level, I guess. Anyway, so that's that. The next one is German Mark. Is that right? Euro, Germany, right? Right. It should be Euro after a certain point of time, but before that, it is a German Mark, Deutsche Mark. Right. So that's that. And then United Kingdom, UK pound, right, has been there. And then what you see, interesting thing, is early 1992. Okay, their currency has been, hovering around back and forth, but relatively speaking, their currency was standing at the time point of 1992. Okay, let's be George Soros, right, or Jim Rogers, right? They were managing the quantum fund, right, the hedge fund, trading in foreign currencies, right, making money out of it. The smash hit they made, right, was the pound's devaluation in 1992. Bam! At this point, they thought like, compared to the fundamentals of the UK, its pound value seemed to be overvalued. Let's short it. And then currency devaluation really happened, and then the short sellers, like those guys, they made a huge amount of money by that. And then afterwards, the UK currency value recovered, and then it was hovering around. And in 2009, 8 and 9, right, global financial crisis, of course. What's that? The Northern Rock or these banks in the UK, they were in so much trouble, so that they had to be devaluing their currency so much, right, in that period. And now it's getting back to those stage, recovering the high level. Okay, where would it go? I don't know. Okay, where would it go? I don't know. Okay, good luck, right? Anyway, evidence on purchasing power parity, right? Purchasing power parity probably doesn't hold precisely in the real world for a variety of reasons, right? For example, Big Mac index, right? The idea, the intuition is there, but in reality, doesn't really hold always. Most of the time it's not exact, right? Why is that the case, by the way, right? Consuming the Big Mac in New York, and should it be the same as consuming Big Mac in Seoul, right? The same product. If we try to fly those burger from New York to Seoul, by the way, there's a lockdown so much so that we don't know whether we will be able to import those things. But yeah, at least in Korea we don't have lockdown, so we can import that Big Mac. But it's gonna take some time, like 13 hours, right, or 14 hours direct flight. And then after 14 hours, you will have a cold Big Mac. Is that the same quality as before? And then there's a chance that this will go bad, right? Sogo kind of things in Korean terminology, right? So there is a problem of keeping the quality the same, and also the price of rent, right? The Big Mac or McDonald's, it's really about what? Real estate business. Okay, they try to spot the place for their shops, for the best place where the people can get around, the place with the most, how do you say, least social distance of the people, which is going directly against our the current philosophy of keeping the social distance, right? The most crowded area, they try to spot those things and then rent those buildings. Okay, so the Big Mac cost, right? Big Mac cost, it will include the rent prices of those real estate. Well, the rent in New York versus rent in Seoul, would that be the same? We're talking about Gangnam style. Gangnam would be even more expensive than Manhattan for a certain period, a certain area. Okay, but if you compare like a Gangnam with this Big Mac with I don't know, somewhere in the rural place of Japan, right? Their rent expense will be hugely different. So those kind of cost, right? Cost items may be different. Also, let's see this haircut. If you think about this haircut, by the way, I don't get my haircut for a long time because if I get my haircut, first of all, my daughters and then my wife will kill me. They like my longer hair than shorter hair. Okay, I never knew that before I got married, right? My high school is called 상문 고등학교, which is like famous for short hair. If you're from Gangnam, in Seochogu, right? 상문 고등학교 is like one of the most horrible horrible high school that the teachers were forcing us to keep our length of our hairs 2 centimeters maximum. Okay, not minimum, maximum, so that it is beyond that the teachers will cut my hair. So I had to I was forced to keep my hair short. So that was a traumatic experience. So afterwards I wanted to, don't touch my hair, please. Don't say anything about my hair. I'm gonna beat your, like, all the bad things, right? If you say anything about my hair, right? That thing was there, but I never knew that longer hair is better for me than shorter hair. And then my daughters, right? They say, don't you ever have a haircut, right? It's better for you to keep it long. Okay, thank you. Number 2, social distancing, right? The coronavirus, right? What if, if I go to the hair salon or barber shop, right? And then the guy or the person who cuts my hair happens to have that virus. I don't want to get infected. So don't force me to go over there. Anyway, now getting back to haircuts, right? Haircut price, the service of the haircuts, right? One of my nephews is a famous hair designer in 가로수길, right? Then he is giving this haircut service, right, for very famous people. And then the haircut service in Korea, in 가로수길, and then the haircut service in New York, and the haircut service in South Africa. Law of one price would say they should have the same price, but should that be the same price? The haircut costs 10 times as much in developed world as in the developing world, right? And then even within Korea, right, the haircuts in that special stores in 가로수길 should be way more expensive than the haircuts in my little town over here, okay, in Gangbuk, right? Gangnam versus Gangbuk, right, will be a lot different, and a lot more different if you go down to rural areas in Korea. Okay, and film or movies, right? Film, on the other hand, is a highly standardized commodity that is actively traded across borders, right? Um, so the films, those movie tickets, don't they have to have the same price? Maybe the differential may be smaller, right? Hollywood blockbuster, right? I don't know how many of you watched this 기생충 or Parasite so far, but yeah, you better watch it, right? A lot of interesting things going on in 기생충. By the way, that 기생충's 박사장집 is right close to my house over here. Not really, just kidding, but it's just a 5 minutes drive from my apartment. Okay, I wish I live in their 박사장집, right? After all, we are all living in 박사장집's basement floor, but I mean the top floor, right? Not the bottom floor or the basement floor. Go watch it, man. Anyway, shipping costs as well as tariffs and quotas can lead to deviations from purchasing power parity, right? Tariffs, right? It gets back to your macroeconomics 101, 관세. Isn't that Donald Trump's favorite subject? Bashing other countries and bashing China. Okay, whatever, China, kind of things, right? By the way, do you think Donald Trump will be successfully re-elected or not? Okay, given that we have this virus things going on, okay, the whole mess all around, right? The crisis, Corona-19 virus. Would he be re-elected or not? Well, we don't know. But more important question is, if the opposition party, the Democrats, gets elected in the U.S. presidential election, would the U.S. companies stop pulling out of China and then re-enter China and then do their business again as they did in Obama's regime or the Clinton's era? Would they do the same level of business with China? And my guess is that no, the good days are gone for China, right? Why do I say that? Well, you meet some American people, right? And this is what they say. The whole basic flow, okay, of getting out of China, pulling out of China, is nowadays shared among different parties, right? Regardless of being Democrats or Republican, they agree, okay? They say, we need to get out of. We had too much invested in China. Now, instead of globalization, wasn't it Chinization, okay? Essentially, they created Chimerica so much so that they got into so much trouble these days, okay? In terms of the labor force, the job exports, and all these kind of things. Too much has been going on. So that's why even if the Democrats or independent gets reelected, their movement out of China will be irreversible. That's what they say, okay? What American friends of mine say, okay? So that's one thing we have to notice, right? Don't cheaply believe that Trump is going down, so the movement back to China will happen. Good luck, right? Not that much, right? Shipping costs, tariffs, and quotas. Quotas, like what? Trading, like a certain amount exchanged, right? And can lead to deviations from PPP. It's a quantity-based trading, quota, instead of price-based ones. So that's why. And PPP determined exchange rates, still provide a valuable benchmark. And then Exhibit 6.8 gives a guide to world prices. This is Big Mac, what's that? Index, right? The same hamburger priced in different currency regimes and then converted into US dollar terms. And then how much would that be? Okay. And then you see hamburger and then aspirin, okay, 20 units, right? 20 units? Isn't it the unit of aspirin that one of that Korean student took, right? here's the story a couple of days ago, right? This is April 6th or 7th, right? But last weekend, right? One Korean student, teenage guy, unfortunate guy, used to study in Kentucky or somewhere in rural area in America, got sick and realized that, oh my God, this symptom seems like something serious. Maybe the Corona-19 or something. What if? Yeah. And then what? He was afraid if it is the Corona-19 virus, then if he has fever, right, then he would not be able to pass that airport security. So that he would be stuck in America. What can be a consequence? If he gets stuck in America, he has to go to two choices. One choice is not going to hospital at all, which is least likely given that he get detected by the machines, right? They will force him to the hospital. And then the other is just going to the hospital, by the way, right? So he has one choice, like I said. Once he gets there, and then what if he gets, turns out to be he's the guy with Corona-19 virus? Two choices. One, he gets a treatment, which will be very, very expensive in America. 10,000 US dollars or multiple of them can be charged. Well, hope that he gets covered by the insurance, right? The other choice is just sticking home, okay, and don't get any medication at all and risking his life, right? Which would be terrible, okay? Thank God you guys are in Korea, okay? I hope the situation in America gets better, okay, or the all around the world gets better. By the way, what did this guy, unfortunate Korean guy, do? Okay, he wanted to get back to his home in Korea and then see their parents and then his parents and then stay in family, right? Yeah. So what did he do? He took 20 units of aspirin, and then what? Lowered down his temperature, so that he passed that the detection machine, okay, both in America and then Korea. Unfortunately, this guy turned out to be what? Infected already by that Corona-19 virus. Oh my God. So guess how many people were close to him in the airplane, and then during the airport travels, right? Oh my God. So all those people are, getting the tests and then getting traced. And then this guy is getting punished by the Korean government very severely. Tough time, tough life, I guess. Right. Anyway, 20 units of aspirin. Don't this kind of aspirin, the same product, right? Shouldn't they get the same price? Yeah, we hope. Okay. But it does not happen that easily. And then men's haircut and then movie ticket. Okay, doesn't this thing have to have the same price if we convert everything into common currency unit? Okay, US dollar terms in this case. So let's do that. So in all different countries, right, capital cities, right? Where is Seoul, by the way? 은철수 교수님, what did you do? Come on. We are proud to be Korean, and then we need Korean prices here, right? You have Tokyo there, right? How could you? Anyway, so this is just making fun. Anyway, so average price in US dollar terms for hamburger is like this, $4. Standard deviation of this dollar terms price is 84 cents. And then the coefficient of variation, what is this? This one is standard deviation divided by average. That's coefficient of variation. What's the idea in coefficient of variation? We want to see the degree of variation relative to its own average. Okay? The standard, if you just look at the standard deviation by different products, you will say, holy cow, men's haircut, $17. That's huge. And 84 cents standard deviations, that's very small. You may consider that way. But we have to consider the fact that some products like a haircut, the average price is already big in unit. So why don't we normalize our standard deviation with the average, right? So that's why the 17 divided by 49 gives me 0.36, right? And then let's look at this guy, right? Movie ticket 0.32. Aspirin price, on the other hand, is like 0.46. A lot more variation. In absolute dollar terms, it doesn't seem like that big, but given that because of the low average price in the first place, the coefficient of variation is really, really huge. And this tells us that aspirin, okay, their prices vary so much. Okay, vary so much. Why is that the case? The aspirin product itself, Tylenol, 1 drop, okay? Does it get rotten when I move this guy from New York to Seoul? No, it doesn't change, right? But why do we have this kind of huge, so much differences? Okay, largely because of the regulation. 의사 약사, or the medical doctor, and then the guys who are prescription medicine producer, right? Well, perhaps the doctors' interest group, they are the strongest interest group in every countries, right? We don't dare to challenge doctors because those doctors, right? And then the medical groups, they hold our lives like this, right? In this kind of crisis situation, medical crisis, right? Please, doctor, help me. I want to live, right? The same thing goes on. So even in the political turmoil, like in 박근혜, when we had the impeachment of the president like a couple of years ago, right? The medical doctor who was also accused, okay, the medical doctor of the president who was impeached, right? The medical doctor, okay, of the president, he had some issue there, related issues with it, but safe, okay? Nobody ever touched him, right? So the biggest interest group in the country, one of them is by far the medical doctor group. Don't dare to touch them, right? So that's why we have such a huge variation in prices in aspirin or medical product, okay? Anyway, so that's fun factor. Let's go. Approximate equilibrium exchange rate relations hold like this. So here we try to diagram those, what's that? The forward versus spot rate exchange rate differentials, like this guy, okay? F minus S over S, remember that? We try to explain it using 3 different things, okay? One is actually just a representation of this, okay? The differential or the change in foreign exchange rate over time, okay? We are trying to expect it using forward rates. And the other 2 are actually those economics concept. One is interest rate differentials, and the other is inflation rate differentials. I mean, the pronunciation is like confusing me when I try to say it, but you see what I'm saying, right? Interest rate differentials explain those change in foreign exchange rates. Well, and then another one is this is interest rate parity, okay? And then trying to explain this exchange rate changes using the inflation rate is something called the forward rate purchasing power parity relations. And then those relation, the theory that explains between these inflation rate, interest rate and inflation rate, is called Fisher effect, right? Fisher effect. And then those theory that tries to explain the change in foreign exchange using the interest rate is called International Fisher effects, right? IFE. And then the theories that try to explain those change in foreign exchange rates with inflation rate is called purchasing power parity, PPP over here. And then the connection between these, the forward rate and the spot rate, and explaining it with the change in foreign exchange rate is called forward exchange rate parity relations. Now, good. Then the exact Fisher effect, okay, getting back to our economics 101, right? The increase in the expected rate of inflation will cause a proportionate increase in the interest rate in the current country, okay? And then for the US, the Fisher effect is written as follows, right? The nominal interest rate I on subscript dollar plus 1 should be the same as 1 plus rho, which is what? The real interest rate, okay? Rho. And that, how do we write this rho, the Greek letter? You need to go back to my previous class discussion, the week 6 lecture first part. Underbar RHO in your insertion of mathematical notations, right? And then, not is it underbar backslash, right? Backslash rho, and then dollar, the real interest rate plus 1 times 1 plus inflation rate, okay? And that inflation rate, to be precise or scientific, it has to be the expectation, okay, expected value of inflation, what people expect to happen in the future, right? So that's that, where rho is the equilibrium expected real US interest rate, and then the expected value of what? Pi is the expected rate of US inflation, and I is the equilibrium expected nominal US interest rate, right? So when the expectation about inflation goes up, what happens to your nominal interest rate? Goes up together, all right? Now let's see, right? Good. The Fisher effect holds in the US. If that is the case, then this should happen in the equation, and then we are trying to bring the international Fisher effect. Okay, international Fisher effect. You're using US dollar and Japanese yen. Okay, hajimemashite or konnichiwa. Arigatou gozaimasu. And then the Fisher effect in hold in Japan, let's say that is 1 plus interest rate in Japan, Japanese yen should be 1 plus real interest rate in Japanese yen times 1 plus expected inflation rate in Japan. And if the real rates are the same in each country, what should we have? Then we get the international Fisher effect. そうですね. So this is this is what we've seen before in previous slides, right? 1 plus interest rate of your currency over 1 plus interest rate of your foreign currency should be equal to 1 plus your expected inflation rate of your currency over 1 plus expected inflation rate of your the foreign currency, whatever. Right? So this has to hold, right? And some of you may wonder, expectation notation is covering 1 plus this guy. Is that the same as 1 plus expected value of this Japanese yen, right? And the 1 plus expected value of inflation rate in your currency or the other currency, right? It's the same. Why? This is just expectation notation, and then 1 is just a constant. Constant, it doesn't change. It's fixed from one period to the next. So expectation of 1 should be 1. Okay? Whereas the pi, okay, as I said before, I mean in other class, I guess, is a random variable, right? Kobrang, kobrang, which means it fluctuates and we don't know where it will go in the future, right? It's a random variable. The expectation is about this random variable part. The constant gets out of this bracket, so that's why. Anyway, so getting back to this, all right. Okay, international Fisher effect, right? If the international Fisher effect holds, then this relation holds, and if interest rate parity holds, then this left-hand side term will be equal to forward rate over spot rate. Makes sense? Then the forward rate purchasing power parity holds. Like forward rate to spot rate should be 1 plus inflation rate over 1 plus inflation rate. Okay? So forward PPP holds like this. Now, the next one, yeah, exact equilibrium exchange rate relationship holds like this, right? As it turns out, okay? It's mathematically it's provable this way. That's the whole thing I'm trying to say. Previously, I was just with this wiggled equality. I was trying to say, the intuition is there, right? But this is, okay, mathematically provable things, right? And if you, right, go ahead. Anyway, so purchasing power parity wise, right? 구매력 평가설 kind of things in Korean terminology. In terms of purchasing power, how big is India? India, namaste, right? Namaskar, right? So what you see on the left hand side is the GDP at market exchange rate in $1 trillion in 2014. And then we are ranking those countries from rank number 1 to rank number 15. And what you see on the right hand side is the GDP at purchasing power parity exchange rate in $1 trillion, right? In 2014, okay, reflecting those purchasing power of these different currencies, right? And then as you see in the GDP at market exchange rate, US was the biggest country in 2014 and China was number 2 and by a wide margin. And then number 3 was Japan by a wide margin again. And Japan, UK, France, and Brazil. Where is our India? Italy and India. Over here. Oh, yeah, come on. Yes, over here, right? India turns out to be over here. But, the thing is, where is India? Come on, here. I'm sorry. Sorry, Canada. India is ranked number 9. But one thing to consider is that India, okay, not only the per capita GDP is low, but their price level is very low in the first place. So that if you divide those by price level and then consider purchasing power, then the GDP of India is actually way bigger than what it seems. Okay, and then China is over here and US gets flipped. Okay. Which means the price level of US is way higher than China, so that's why. All right, forecasting exchange rates, right? After all, okay, think about what we've been doing so far. Those international parity relations using interest rate parity and purchasing power parity. What are we up to? Okay, we're trying to come up with a model of forecasting or trying to explain the forward exchange rate. Okay, forward exchange rate, that is future spot exchange rate. Okay, how can we understand at least the forward market, and that may be, having some predictive power about the spot exchange rate going into the future. Okay, so can we make money, okay, by investing in FX market and then the foreign exchange traders, right? As you get a job over there, you may want to, better predict, better forecast those foreign exchange rates going into the future, all right? But is it possible to do that is a valid question. The forward rate already is there, and then those market participants set up those price like that, okay, reflecting all those information, relevant information, right? And what does economist say? That economist, I'm saying Chicago, Minnesota, Carnegie Mellon School of Thought, guys. Okay, Chicago, Minnesota, Carnegie Mellon School of Thought, the triangle. We call them neoclassical economists, right? These guys always say what? Market is efficient, right? Efficient. And then you cannot predict the market, okay? You cannot predict the price. And market efficiency guys say what? Price reflects all those relevant information already, okay? By the time you believe that you can predict the market based on your information that you got, well, tough luck. The market knows at least as good as you, okay? The market participants are very, 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 very smart guys, and they are working with supercomputers in the first place, and they have much better information sources than you and me, okay? So give up, man. Come on, just be the price taker, and then don't try to dare to predict, right? You're gonna be underperforming later on, okay? Sometimes if you are lucky, you may be outperforming, but that's very temporary. But on average, you will be underperforming. You will be worse than the market. So if it is in stock market, what do they say? Well, be a passive investor by investing in index funds only, right? Then foreign exchange market, what do they say? Similar idea, okay? They say foreign exchange rate already reflects all the information necessary, relevant, right? For example, can you predict US dollar price going into the future 6 months from now? No, okay? Random walk will be there, random walk, okay? Unpredictable, okay? And then if this is true, then exchange rates will only change when the new information arrives. FX rate will change in a very unpredictable manner, first of all, and it will change reflecting those information coming up in real time. By the time you get the information and then you realize, oh, there is a new information, that then the price has to go up or down. Up, let's say up, then the price already moved up before you take any actions, right? So in real time basis, it works like that. So spot exchange rate, okay, is equal to expectation of future exchange rate. The best guess of tomorrow's exchange rate is today's exchange rate. That's it. Okay. And forward exchange rate. Excuse me. I hope this is not a virus, right? Anyway, forward exchange rate, okay, given today's information, right? That's this guy, forward exchange rate, given today's information, right? That's forward exchange rate is our expectation about next year or next time point, t+1, okay? Standing at today based on today's information. Okay, this is what the market efficiency guys say. Okay, predicting exchange rates using the efficient market hypothesis is affordable and is hard to beat. Okay, essentially that's what I'm summarizing what I've said before. And then forecasting exchange rates, fundamental approach is also there. I told you before, right? Warren Buffett, is he a believer of market efficiency like Chicago, Minnesota, Carnegie Mellon? The answer is no. You wish yes, because Warren Buffett is such a famous figure all around the world, so that he shows up in the media so many times, in financial media, and then he says, the fundamental intrinsic value will be realized in the future. Does that mean that he is a strong believer of market efficiency, like Eugene Fama of Chicago, Minnesota School of Thoughts? No. Okay. Warren Buffett kind of guys, right? The fundamental approach guys, intrinsic valuation guys, they don't believe in market efficiency in the short run. In the short run, right? They even argue that all of the stocks or all of the assets can be in a bubble, deviating from fundamentals like crazy, all of them, or crashing altogether, right? Relative to, compared to the efficient level, okay? Whereas the Chicago, Minnesota, Carnegie Mellon guys say there's no such thing as bubble or crash. It's just reflecting the fundamentals. Okay, so the fundamental guys also here, okay, in FX market. Okay, what do they say? What do they say? Well, it involves econometrics to develop models that use a variety of exchange rate variables. This involves three steps. Step 1, estimate the structural model. Step 2, estimate future parameter values. And then step 3, use the model to develop forecasts. And then the downside is that fundamentals models do not work any better than the forward rate or models or the random walk model or efficient market model. There are, essentially what I'm trying to say is that there are some guys who try to go through this fundamental approach. What's the intrinsic value, right? Reflecting all those GDPs and the macro variables of the countries, and then those fundamental relations, and then there has to be some intrinsic value, okay, of a certain currency. That is not, that those intrinsic value of the currency may deviate from the price of this currency, FX rate. Well, you need a strong assumption that this currency that you're interested in is not efficiently priced. But if it is, usual currency that you think about, okay, Korean won relative to US dollars, very frequently traded. You think Korea is a very small country because we are all supposed to be polite and we are brainwashed to believe that we are small guys and then we are nobody but you, right? But actually Korea is not such a small guys, right? And in terms of GDP, out of 300 different countries, this is top 10 or something, or 11. Okay. So major currencies like this, would there be inefficiency in pricing? Least likely. Well, the story goes the other way around if you say North Korean won. Right. Who has North Korean won? By the way, what's the exchange rate between US dollar and North Korean won? I don't know. God knows what. There, you may think about some kind of inefficiency and then use some fundamental approaches. Now, what's the fundamental value reflecting Kim Jong-un cash flow and risk? I don't know. The trouble is, we don't have the data. But that kind of rare currencies, right? Small countries, rare currencies. There may be, okay? But we're not interested in that kind of market in the first place, right? And then for this kind of usual currencies that we talk about, right? They're efficiently traded, okay? And then technical approach is also there, right? Technical approach, 기술적 분석, chartist approach in Korean terminology, 기술적 분석가들, right? Technical analysis looks for patterns. It's I told you before, pattern recognition is the past. Technical analysis looks for patterns in the past behavior or exchange rates. It's based upon the premise that history repeats itself. Okay, repeats. Okay. Good luck. Thus, it is at odds with the EMH. EMH says what? If it should repeat, and those repetitions should take place in a millisecond and reflecting all those things, your repetition, expectation, all at once, so much so that it will shrink down, okay? And the price changes. Price changes happen instantaneously instead of waiting for that change to take place over 1 year horizon or something. Okay. Now, technical analysis. Let's go further, right? Technical analysis. Why? Because this is the one that you will see more often than not. Okay, and it is kind of fun. Okay, and it has some kind of intuitive appealing. Okay, that's why the technical analysis has been popular, and then it's widespread in no matter what. Okay, it scratches your itchy point. It scratches your basic instinct, animal instinct, right? Pattern recognition. Okay. So moving average and crossover rule is one thing. One famous technical analyst tool. For example, golden cross and then dead death cross, right? Dead cross in Korean terminology and golden cross they say. So what is that about? Well, here we have a diagram or chart, conceptual chart of FX rate, dollar per pound, let's say, the pound value with respect to, I mean, in terms of dollar terms, right? So the black one, okay? Black one is, what is that? Moving average over short-term moving average. Let's say 1 week moving average of this FX rate. Okay, it fluctuates more often than longer term moving average, right? And then the blue graph, let's say this is 1 month, right? 1 month moving average. Did I say short-term moving average is the weekly moving average? For example, right? Weekly basis versus monthly basis. Of course, monthly basis moving average will be slow moving. And then there will be some time point, of course, 2 different lines that is not strictly linear, but 2 different lines, whatever wiggle, they're supposed to cross each other at 1 point or 2 points or multiple points. And then here they're trying to make up a story, okay? So that golden cross is defined as the one where your short-term moving average is crossing over to the long-term moving average, and then start to go give better moving average in the prices. And dead cross is the one where your short-term moving average crosses the long-term moving average downwards, so that you're trying to infer or some kind of you are trying to, how do you say, make a justification in yourself, right? And say that, oh, it's just past the golden cross. It's a signal that the market is moving upward and in a reliable manner. So buy. And in dead cross, if it is passing that, oh, this is a signal that it will never return. Okay, it's a very bad signal. We will never go back to up again. That's technical analysis approach, right? Which is against market efficiency, guys, but has some appealing, and then it is useful in certain sense, right? Why? Let me tell you upfront. If everybody is using, okay, or absolute majority is using this kind of golden cross and death cross ideas, and then trade based on it, it will be more rational for you to follow them and predict and using their technique, and then say, oh, past the golden cross, everybody else will move together, right? It's like a beauty contest kind of idea. When it comes to beauty contest, and then you are the evaluator, right? This is Keynes' argument, right? Let's say Miss America, we are selecting Miss America somehow, okay? And then you are the evaluator, the judge, right? And there are a group of judges. And which one would you choose as your best candidate for Miss America? Well, that will be the one that everybody else will be, that you expect that everybody else will say the most beautiful person over there, right? So your trading will be based on other people's movement, and you rationally expect other people's movement based on this technical analysis. Well, under that assumption, this kind of moving average or technical analysis has some appeal there, right? It may be more rational for you to follow, okay? Given the market traders movement. And now the next one is a technical analysis tool as well. Head and shoulder patterns. Head and shoulders, knees and toes, knees and toes. Head and shoulders, knees and toes, knees and toes. Eyes and ears, and I don't know where the eyes and ears are gone, right? But this is the idea, okay? What? We try to recognize this pattern as a human being, right? Does anybody say that this has to be human face or human body? Nobody, but let's just take it that way. And then it has some, people want, it's natural instinct that we want to impose certain pattern that is close to human body, and it's easier to understand, make it people understand, right? Understandable. So what you see on your horizontal axis is time, and then this is dollar per pound exchange rate price chart. Okay, somehow, oh, it looks like a human being, and then the top point over there seems like, let's call it head and shoulders, and then whatever it may be, I don't care, right? So that, what is that? You have left shoulder, identify it, and then right shoulder, you identify it, and then between these two points, okay, you cross it and say what? Neckline, right? Let's call it a support line, supporting your head, big head, by the way, okay, big head. And then, so that what's the story? If you are over here, okay, what's the here, right? If you're over here, okay, you would say what? Here's a support line, so I don't believe the price will go down, okay? So let's buy it, okay? That's one prediction you can make. Number two is that what? Here's a neckline, the support line, and if it crosses downward, then this is a signal that we have to sell off. Okay, this is a bad signal. Okay, two ways you can say it. Okay, but who says this is the top? Who says this is just a shoulder? Who says this is, really the neckline? If you expand the time horizon, this may shrink down to nothing. Okay, that's kind of what I'm trying to say. The pattern recognition is in the eyes of the beholder. Okay, in the eyes of the beholders, right? 네 보기에 그렇지, 내 보기엔 안 그런데, kind of things, right? In Korean terminology, right? Anyway, performance of the forecasters. Well, forecasting is difficult, especially with regard to the future. As a whole, forecasters cannot do a better job of forecasting future exchange rates than the forecast implied by the forward rate. The founder of Forbes magazine once said, you can make more money selling financial advice than following it, right? So, so this is forecasting always, the economist, right, are supposed to be skeptical about this forecasting job. Remember Professor Untitled 교수님, and then Resnick, they are economists. They're not technical analysts. And me too, right? 99.99% of the professors in finance and economics, right? We are proud to be claiming as economists. Chicago, Minnesota, Carnegie Mellon, the top, very top guys in the whole world, we dare say it, right? How many Nobel Prize did the Chicago guys won, right? Super duper, like this. So that's basically our approach, and say what? The market is efficient. Nobody can beat the market. Don't dare to forecast anything, right? So this is academicians' bias, I would say. Behavioral finance guys have different take on it, right? Which I am, right? And say, what? Market is really efficient, and we find all these kind of different evidence of breaking down of market efficiency. But foreign exchange market is really hard to find those evidence. But that's something I'm interested in to find some from now on. Okay, why foreign exchange market it is hard to find such this evidence of behavioral finance or evidence of breaking down of market efficiency? Well, because of the traders, right? The investors in the foreign exchange market, right? We are not talking about the retail side of the exchange market. We are talking about the interbank foreign exchange market. Okay, wholesale bank, not the retail, but the wholesale, right? FX market. Who are those market participants? They're not like you and me, right? They are Goldman Sachs, Bank of America, or Korea Exchange Bank, Kookmin Bank, all those big banks equipped with their best of the best machines and the best of the best people, right? How can they be deviating from, those efficient prices? Impossible, almost impossible. And then it is traded every millisecond. And those high frequency traders are already there to capture any deviation from the efficiency level. So it is very extremely hard to find any behavioral biases going on in the FX market. Oh yeah, maybe you can find it if it is like a North Korean foreign exchange, right? But usually not, right? So that's that. Summary, it is self-explanatory, so go ahead and read it. So basically all these things, right, that we discussed in this chapter is about spot exchange to forward exchange connection, which has to do with those forecasting, okay? Any predictability there, right? Can we predict using our model and then deviation? Can we find anything? Arbitrage opportunities, can we find it? If so, let's make money. But the thing is, interest rate parity and then purchasing power parity, all in all, the international parity relations hold so strong that it's going to be very hard to find great arbitrage opportunity in FX market. But there are some arbitrageurs still making money, right? High frequency traders, they are busily identifying those opportunities using their supercomputers. Right? It's for your career, going into the future, right? Maybe you should familiarize yourself with computer coding to find out and then trade in FX market, and using this algorithm, reflecting all these IRP and PPP kind of ideas there, right? So good luck, and then see you next week.